Private real estate syndications are becoming increasingly popular for investors of all kinds. But what happens when real estate syndications go wrong? We're going to break it all down for you next. Now, passive real estate investments can enhance an investor's portfolio by providing diversification, income, and tax benefits. But real estate isn't easy, and sometimes things do go wrong for a syndication and all of the investors involved. So on today's show, my expert panel and I will discuss what can go wrong with real estate syndications and how you can learn from these lessons to put together better real estate investments. Welcome to Fund Playbook. This is a show that is all about how to launch and raise capital for your very own private fund or real estate syndication. I go live every Thursday at 3 p.m. Eastern Time. Just hit that subscribe button to follow the show. I'm your host, Jimmy Atkinson. Today, I'm joined by two real estate syndication experts, Andrew Doup of Syndication Counsel and Brett Siglin of Fenimore Law. They're both joining us today from Phoenix, Arizona. Gentlemen, welcome to today's Fund Playbook Roundtable. Brett, we'll start with you. What percentage of real estate syndications go wrong?
I would say over half. Probably over half of sponsors that are out there fail to raise sufficient amount of funds to get the deals done that they want to get done. And we'll talk about all the reasons why that is.
Yeah, I'd love to talk about the reasons why they fail to raise the amount of capital they need to. I'm sure there's a lot of other ways that the deals can go wrong as well. But Andrew, want to get your take real quick here as well. What percentage of real estates go wrong in your experience?
Yeah, first of all, Jimmy, thanks for having me on the show. Andrew Doup with Syndication Counsel. We're a boutique law firm that advises entrepreneurs on how to navigate compliance with securities laws to raise investor capital with confidence. I'm going to echo, Brett's observation. I would say about half. And that's, sometimes the best deal is no deal, and we can talk about that as well. But when I think about the different ways that a real estate syndication can go wrong, the three primary ways, that I see are, either the partnership doesn't work out. Real estate syndications are an investment partnership after all, or something goes wrong with compliance, whether it's corporate compliance, tax compliance, securities compliance, generally. And then, third, just the deal itself doesn't work out for whatever reason. So look forward to this discussion.
Yeah, absolutely. And by the way, for those watching the live stream right now, if you have a question for me or my guests, as always, please submit it using the chat feature on YouTube. Don't be shy. We want to get to as many questions as we can. My guests and I will save a little bit of time toward the end of today's show to answer some of those questions. So we discussed percentage-wise. You both say about 50-50, about 50% of the time a deal goes wrong for one reason or another. Andrew, you just mentioned some of the ways, the three ways the deals can go wrong. Can you go into a little more detail? What are those most common ways a deal goes wrong in your experience? And, within that, if it's not just a matter of raising enough capital, how does a deal end up falling apart maybe after it's raised a lot of capital?
Yeah. You know what? Let me actually amend my response. I'm going to say that 100% of the deals go wrong.
Oh,
and what I mean by that is that there's always going to be some obstacle or some challenge that a syndicator or that an investor is going to be presented with. And that's what I love about this work that I do in real estate syndications is that, it's a partnership. You've got partners coming together to create an outcome that are greater than the sum of their individual parts. So how do we identify those challenges and how do we work as a partnership to move past them? To me, is what makes a difference between ultimately a successful real estate syndication and not a syndication gone wrong, but a failed real estate syndication.
And Brett, in your experience, what are the ways that a syndication ends up going wrong most likely?
I would say the most common way is it's probably bad planning on the front end, and oftentimes that happens with sponsors that haven't raised money before. It might be their first time. They might be really experienced at development in any number of industries or asset classes, but they haven't gone out and tried to raise the money on their own. And it's a different game, and it's been fun over the last 7 or 8 years because obviously all three of us have been pretty active in the opportunity zone space, and we've seen more and more you know, first time sponsors, right? And maybe it's a little harder to get that money committed than they first anticipated. And you never know when you're starting. I mean, you might have people that you want to talk to that are interested in you or interested in your deal, but until they write that check or wire that money, you just don't know. So I think that's the biggest obstacle, right? And then the other one would be, just market conditions that you have absolutely no control over, right?
Yeah, well, let me pick up on that first topic you brought up. Just
Yeah.
difficulty in raising capital. Somebody's maybe put together some deals before. They might have a lot of expertise in a certain geography or a certain asset class or sector within real estate, but maybe they've only done deals with friends and family money or their own money. Then they want to go do a bigger deal. They get a 506c exemption. Let's say they're ready to raise capital, but then they hit the streets. And then what goes wrong, Brett? Why can't they raise the capital? What are some things that they're missing typically?
Yeah, I would say, well, typically it's somebody that's really ready and willing to step up to bat and make that commitment on the front end, right? Because when you're launching the fund, you're really at the seed capital stage. So, hey, I've got a piece of dirt. I'm going to buy this potentially, and I really need some equity because I can't get debt until I have some skin in the game, so to speak. And so that first nut that you have to crack is really the hardest one. And I think once you get a single commitment, it gets easier and easier. And then there's like a snowball effect. If things go well and you time it right and you hit the market right, it starts to build momentum, right? Like you end up being on Jimmy's shows, or you get on pitch day, and then all of a sudden you got 100 people calling you. But it's that first one that can be really challenging. And what I've seen, is that the groups that start a little more humbly, like, hey, I've got a few people, like maybe it's my brother or my cousin or my friend or somebody I went to, law school with or whatever. There's 4 or 5 or 10 of us, and we're really in this together. Those
Getting
held,
that first one's always really tough though. And I think starting with friends and
when
families.
you go out and you try to, launch it to thousands of people, it gets mixed up with so many other deals you're competing with, and it's harder.
Absolutely. Yeah. No, and we ran I think one of the first videos we ever did, one of the first podcast episodes we ever did on this show was how to find your first investor. Andrew, what are some of your thoughts, insights into, okay, I put together a few deals before, but now this is the first time I'm going out to actually raise capital from outside investors that I'm not familiar with. Where do those folks tend to fall short when they're raising capital for a syndication?
Yeah, I mean, the first place they fall short is in trying to do it on their own, without the advice of securities counsel or corporate counsel, because that's where you run into not just an inability to sell an investment, but into real, regulatory liability risk. And that includes both civil and criminal. So, I think at the outset, if you're thinking about raising investor equity, that's amazing. Hopefully you've got a track record that you can put behind it and help use when you're making that, compelling pitch to your prospective investors. And if the answer is yes, then you want to look to legal counsel with expertise in securities laws and securities regulation, because securities industry is highly regulated, and with qualified counsel like Brett or other securities counsel, they're going to be able to put you in a position where you're most likely to succeed. Because our worst scenario is securities counsel is to spend a bunch of time and money putting together a set of offering documents that doesn't sell. We don't want that for our clients. So for first-time syndicators, just by way of example, if they aren't super confident in making that substantial upfront investment that it takes in order to, take a securities offering to the market, then, instead what I might recommend is begin with the term sheet. Have a discussion with someone you might consider a lead investor, so that the terms that you're offering are acceptable, that they'll sell. Because chances are, with a smaller upfront investment into a term sheet, that, if you can get a verbal commitment on that from at least one investor, then chances are you're going to get a commitment from additional investors as well.
Well, now let's say that the capital raise isn't the problem. They've got the money lined up. What are some ways that a deal can go wrong after all the money's lined up and we've got some LPs in the deal and we're ready to go? How did the deal fall apart at that point?
Yeah, so what's often happened in recent years is there's been delays and there's been cost overruns, especially when we're talking about real estate development ground up. And those stem from factors that are usually beyond anyone's control. But sometimes, maybe there's an argument that the sponsor team, should have control over certain factors, right? So costs, having to make capital calls, potentially having difficulty finding construction financing, and that's certainly affected by interest rates, which we've seen, go up a lot in recent years. And then, the construction costs have been a huge factor, but also just getting deals done, labor shortages. There's so many things that can go wrong. And, if I'm one of your early investors in your fund, I'm really kind of at the seed stage. So I'm taking on more risk there. So I've got to have a lot of confidence in that team to execute.
Absolutely. Andrew, how about you? What are some other thoughts you have on how can a deal go wrong, even if all the capital's lined up properly?
Yeah, really, I'm going to go back to, the three ways or the three primary risks to a real estate syndication being, partnership uncertainty, regulatory uncertainty, and then deal uncertainty. Brett spoke about some of the macroeconomic factors that can affect deal uncertainty, and about some partnership uncertainty as well. That can arise from a lack of experience or a lack of clearly defined rules, rights and obligations that should be in an operating agreement or the instrument that governs the agreement between your GP and your LPs or your management team and your passive investors. Macroeconomic factors, so deal uncertainty, partnership uncertainty, and then finally regulatory uncertainty. You want to make sure that your securities offering, even after the equity is raised, that you're still using the investor equity in compliance with rules that govern what you can and can't do with that passive investment. And basically what that means is two things: consent and disclosure. If because of whatever macroeconomic factors, your business plan changes or your investment strategy changes, that's okay. So long as you get investor consent about those changes and that you're disclosing what those changes are to your investors so that they're not left out in the dark.
Let me talk about rights and obligations. You mentioned that as a part of the things that can go wrong at the deal level. If it's unclear what the rights of the LPs are and what the obligations of the GPs are, can you give us an example of how you've seen that get screwed up?
Yeah, often it's not clear, right? And so when we're investing or when we're representing investors who, our first question is, were you provided a disclosure, a private placement memorandum, or a subscription agreement? Do you have an operating agreement or something that can help us understand what you're buying in exchange for the check that you're writing? Because, any ownership that in a real estate syndication is going to come with various rights and obligations that you're buying into, and you want to gain a clear understanding of what that is, because yes, maybe you've reviewed their pitch deck or their investor deck or whatever, and you like the financial returns that you're being promised, but your inquiry shouldn't stop there. You should also want to know, when you should expect to receive, tax reports. Are they going to be made on time or are they going to be late? If so, should you plan to make a late election on your individual tax return? Is the sponsor obligated to keep you informed of, fundraising status or project timeline? And do you have a right to vote as an investor? Do you want a right to vote as an investor? Maybe the answer is no. Maybe you really do want it to be passive and you just want to be updated about how the project's going. So all of these details, these offering terms, should be disclosed in a private placement memorandum or something similar, so that you can better understand, what all the legalese says in the operating agreement or the LLC agreement.
Very sound advice. The late tax filing documents hits a little bit too close to home. I'm an LP in a number of funds, and it seems like most of them I get my K1s on time, but there's always one or two where I'm waiting until June, July, August, in some cases even like the following January before I get the K1 for the prior year.
Yeah.
When I'm starting to get the 24 K1s from some of my investments, I get the 23 K1 for one of my other investments about a year late. But I'm sure every LP who's made investments in a variety of funds over the years probably has one or two of those stories about late K1s. That can always be a drag. Brett, I want to turn back to you. I want to hear some real world stories now. What are some of the craziest real estate syndication disasters you've seen?
Yeah, and I want to go back to everything Andrew was just saying is true, right? And if you're on the investor side, you want to be the one asking those questions and getting those disclosures. But if you're the sponsor, you don't want 120 different people barking at you, every week, and especially if they're putting in, 25 or 50,000 each. I mean, God love it. You take the money you can, but that can be a curse too, right? I mean, if you're so successful that you've got so many people in your fund, you may not be equipped to manage it adequately, and you might not have the resources to get those K1s out and to hire the accounting team that you need. There's a lot of asset management that goes into these that I think folks kind of underestimate maybe on the front end. And you grow exponentially. There's always growing pains, right? So I would say, yeah. I mean, one of the horror stories, the worst deals that I've been involved in involved groups of really well-intended sponsors. Oftentimes they'd never done a deal together. They're coming together and they all had great ideas, and they're all really successful people in various entrepreneurial enterprises or in other professional capacities in life. And sometimes they're geographically dispersed. So I've been involved with funds early on in my career where you might have 4 or 5 people in 3 or 4 different states that have all these great ideas, and then they want to raise $500 million, and they're going to build like the next Disneyland, somewhere outside of Fort Worth. But that's an extreme example, but it's that sort of thing, right? Like, yeah, I think we can do this, and we've got this great plan, but we really have no idea what we're doing.
It's always hard. It's hard putting a real estate deal together to begin with, let alone if you guys are working remotely in different parts of the country. That's for sure. Andrew, how about you? What are some of the craziest real estate syndication stories or disasters that you've come across?
Yeah, just one quick comment about the late K1s. A common question that I get from clients who are workshopping and offering terms for a real estate syndication is, how can I make my deal stand out? And my response is always the same: deliver timely K1s. That is how you can stand
I love
out.
that. I absolutely love that. Hey, by the way, we did also just get a comment from Andy Higgins that says, "Oh man, I hate late K1s." Thanks, Andy, for the comment. By the way, if you're watching live on YouTube and you have any comments or questions for us, feel free to submit them using the YouTube live chat. Andrew, sorry to cut you off. Some crazy real estate syndication disaster stories. What do you got for us?
Yeah, nothing too, crazy. Really, like I can cover the range of, from crazy to bad to recovering from bad to just tragic. But I'll give you an example of where no deal actually may be the best deal. And it was a deal that actually Brett and I crossed paths on. I had an investor client who was interested in investing into a real estate syndication of one of Brett's clients. And, they came to me and said, "Hey, we've got the offering docs. We just want to make sure that we understand, what we're signing up for." And, of course, the role of counsel is to summarize, all the offering docs so that, most importantly, their expectations are enforceable, right? Like that's the goal for any partner in a partnership. You want to make sure your expectations are enforceable. So in this case, Brett and I connected, huddled up on really just trying to bridge the gap between expectations on both the sponsor side and then the investor side. And in this case, there was a real gap. But even though that deal didn't work out, it didn't close, at least each client was in a position where they had identified what the gap was and then could make a business decision on whether or not, they were willing to move forward and accept the risk of uncertainty with respect to whatever, term.
Yeah, good stuff there. Always need to make sure that the expectations are clear going forward. Brett, how about you? Any other horror stories or
yeah, I'll say that client's done pretty well raising money. So even though that one didn't work out, I agree. Sometimes it's a win-win if the two sides just agree to walk their separate ways. And I think that was also another one where there was some maybe geographic differences. Yeah, I mean, the other horror stories I would say would be just where, hey, you've got a group. It's really sad when there's folks that spend like a lot of time going out there, and they just can't find anyone to commit. Like that's happened a few times, where maybe they just don't have the connections to someone like you, Jimmy, or to others that are out there. Maybe good broker dealers or other advisors. Just making the connection with the right capital people is challenging.
Yeah, I think sometimes when sponsors fail to raise capital, it can be for any one or more of a number of reasons. Sometimes it is just that. Sometimes it's just they don't know where to go. They don't know how to access the right channels to get interest from investors. They don't know which conferences they get to go to. They don't have relationships with RIAs and broker dealers. They just don't know. Another way that you can fail to raise capital, maybe you don't have the budget for it. People put a budget on acquiring the deal and maybe the operations behind operating the deal, but you need a marketing budget and a capital raising budget. And that can sometimes be anywhere between 2% all the way up to 10% of your total equity raise is what I've seen. Kind of varies depending on the size and scope of your deal and which channels you're going after and what existing relationships you already have. But you're going to want to set aside a pretty good sum of cash to raise capital. And then I think the third way you fail to raise capital is, and I hate to be blunt, but your deal just might not be that good. Maybe it's too complicated. Maybe the timing's wrong. Maybe it's in a bad market. Maybe it's in a sector that nobody's really interested in investing anymore. Imagine putting together an office deal in 2021, for instance, right?
Yeah.
So I think there's a variety of ways.
Maybe it's too much like everybody else's deal and it doesn't distinguish itself.
Or it looks too much like everybody else's deal and you're promising to get people their K1s late. So nobody wants to invest in a deal where the K1s are coming in late, right? Well, I want to kind of flip this on its head now. We've talked about some ways that deals can go wrong. We've talked about disaster stories. I want to hear from both of you. And Andrew, I'll start with you. What are some signs up front early on that it looks like a deal is going to go right, that everything is going to come together, that the partnership's going to work, that the capital raise is going to come in, and that the deal is actually going to perform, if not outperform, the expectations set forth in any pro forma?
Yeah, and early promising signs, a business plan for starters. You'd be surprised about, how often, clients are thinking about raising a round of investor equity without having finalized a business plan. But, ultimately, that's what your prospective investors are going to want to know. They want to know what your business plan is and what your projected returns look like. All the legal stuff aside, that's what they're investing into. They're investing into a return, and beyond that, they're investing into you as the project sponsor. So they're going to want to know that you've got a solid business plan, and beyond their capital commitment, you've got the other resources around you that you would need in order to execute on that plan. Those are early promising signs.
Good insights there. I do see a few comments and questions in the comments thread in the chat. We'll get to those in a moment. By the way, if you have any comments or questions, feel free to fire away in the YouTube live chat, and we'll get to some of those in a minute here. Brett, how about you? Any additional insights on what do you like to see, whether you're representing a GP or an LP interest in a deal? What do you like to see that looks like a promising sign that the deal is going to work out?
Yeah, I mean, like I alluded to earlier, there's a snowballing effect. You start to see momentum. You start to see more and more people committing. And I think it stays on track, right? Of course, you got to have a plan up front, but then you got to stick to the plan. And if you start missing targets, I mean, the biggest one is, do you even have control of the site? I mean, is it under contract? Are there delays with the city in getting entitlements? You know, if you come up with enough equity to close on the land, and then, you know, what kind of discussions are you having with lenders, and where, you know, where is that going to end up? Who are the GCs? Who are the architects? You know, you can tell usually pretty early on how sophisticated, you know, the team is, just based on, you know, those things. If they've got a professional, organized operation, you know, and it's a good deal, then, you know, it usually tends to pick up and do pretty well.
Awesome. Great insights. Both of you. Want to go to the questions here in the live stream for those watching live. Matt asks, what is a ballpark estimate of legal fees for a straightforward real estate syndication? And he gives an example: purchase of one identified property, 5 to 10 LP investors, the debt's already secured, pending equity funding, etc. Andrew, we'll start with you.
Yeah, my answer is it depends on the scope of work that's involved. And so our approach to better understand what that scope is, we schedule a free 30-minute introductory call so that we can ask some questions and get the information that we need in order to put together a written scope of work proposal together for you, together with an estimate of legal fees, so that you know up front how much to budget. Because, you know, one of the great things that I love about this practice is that, you know, you're offering an organizational expenses, which would include legal, accounting, marketing, travel. That's all reimbursable to the sponsor out of the investor equity. So we want to put you in a position where you can create that budget up front, and so that all of your investors can consent, you know, to chipping into that budget, so that you're doing things, you know, the right way. Typically what the scope of work involves for, you know, a straightforward real estate syndication with a handful of investors is an operating agreement or an LLC agreement, private placement memorandum, the disclosure documents. So you're disclosing to your investors the offering terms, but also the risks that are material to an informed investment decision. Third, a subscription agreement, the legal instrument that's used to not only close on investor wires, but also to allocate the risk of securities liability away from you as a sponsor and onto your investors as informed decision makers. And then finally, a couple SEC filings. We want to establish your safe harbor exemption from state registration requirements by making some filings with the Securities and Exchange Commission. For us, that scope of work, it starts at $12,500, but it can go up from there depending on the scope of work that's involved.
Dude, and Brett, what's your ballpark estimate?
Yeah, I would echo a lot of the things Andrew alluded to there. Yeah, I think it also depends not only on the scope, but the timing and how organized is the client. You know, so we do the same kind of thing. We have usually a 30 to 60 minute upfront call just to feel things out, see where they're at, what they're looking for, and what their timing is. And then one of the first things we do is we put together a questionnaire list. It could be 5 to 10 pages of 75 things, and it can take a while to get that information back. But once we get that back, we can be extremely efficient. So, you know, it can take anywhere from 3 to 4 weeks to put together the PPM and the fund operating agreement and the subscription agreement to get set up for this. Assuming everything's in good course, and it sounds like Matt has up, so that's actually super helpful because usually those folks are quite organized. Are we looking to form their entities? That's usually a couple days or whatever, but we can typically do the initial offering documents for around 10 to 20,000, assuming it's a very well put together group and it's nothing unique.
Okay, well, it sounds like sounds like I did pretty good then. I got a comment on one of our YouTube videos a few days ago. Somebody was saying, "Hey, I found this service that'll do a 506c filing for me for $200," and there was some convoluted thing about a convertible note and stuff like that. And I said, "Whoa, $200? That sounds like a cutthroat operation, like a legal Zoom of SEC filing fees," because the SEC doesn't actually have a filing fee. You're just paying the attorney to prepare and make sure it's filed correctly.
Word of caution. I don't know if you're seeing this too, Brett, but I am seeing like tech companies start to offer real estate syndication services, and that's fine. I mean, I'm all about democratization, but just be sure understand what you're buying.
Yeah,
because the ones that I've seen, like they will, they'll offer template documents, and then they'll leave it to you to then go find your own securities counsel, which you want to do if you buy the offering documents. Make sure you get securities counsel to review them and ensure compliance. Again, with those 3 primary risks: regulatory, partnership, and deal risks. You want to make sure you've got an advisor on your team.
And then that was my word of caution.
Like the worst approach ever. Like if you're going to hire a securities counsel, use their documents instead of expecting them to reinvent some form documents that somebody else generated that have 1,000 blanks in them. I mean, it's harder to take someone else's bad deal and make it work, because we've had to do that before too, and that can be more expensive than just starting with the right forms.
Definitely.
And it takes a lot longer.
I saw one example. It was this online service provider who was selling offering documents for a Series LLC, for their Series LLC. Like it wasn't even like the customer's Series LLC. And I was like, wait a second, we should take a time out and reassess, what it is you actually want to do and why this could be a bad idea for you.
Yeah, going back to Matt's question, I mean, I think if he was talking about a purchase, that's a whole nother thing too, right? I mean, do you need help in negotiating the actual acquisition? Because, there's a separate purchase and sale agreement, and we do that all day long, every day too. And of course, the debt is another piece. So one of the things that at Fenimore we can do is we can kind of offer the full package and do it as efficiently as possible, not just the syndication, but the acquisition, the financing, and the securities and regulatory side of things. So, it can take a little longer that way, but, once it's in-house, it can be a lot more efficient.
Good stuff. Well, I'm proud of my answer then to that gentleman who asked, or maybe it was a lady. I don't remember who it was that asked that, who said, "Hey, can I do this for $200?" I said, "Man, just beware of what you're paying for. You're going to pay for what you get." I think you typically want a budget somewhere between 10 to 50K just to get set up with legal, depending on the size and scope of your deal and what you're doing. If you're raising capital, if you need a PPM, if you already have the entities created or not, definitely it's nothing to sneeze at. The amount of money that you want to be able to set aside if you're doing a serious deal with a capital raising component to it. Ty just chimed in a few minutes ago. He says, "Great insight." Ty's watching us on LinkedIn. Thanks for the thought there, Ty. Got another question in here from Kei Ho. I hope I'm pronouncing that correctly. He says, "Hi, gentlemen. We are in Chicago. What type of real estate deals do you see more doable in 2025 with a better chance of success?" So what kind of deals do the two of you like to see this year? Andrew, we'll start with you first.
What type of deals do you see more doable? I mean, anything's doable. I think what's most important is that you understand the asset that you're investing into, whether it's a 400 unit multifamily property or a fix and flip. I work with a lot of first time real estate syndicators, and that's often, where their experience is. And like, if you're good at fixing and flipping and you just want to do more of it, well, maybe pivoting to Class A multifamily isn't a great idea right now. Maybe instead we should just focus on what it is you're already good at, just scale that up. So I think it depends, it depends on your background and expertise and what the individual is great at.
Yeah, where do you have a track record already? And if you don't have a track record, pick one niche and get started there. First, Brett, how about you? Any insights on what deals you like to see or what works in 2025?
For 2025, what's sort of been screaming in my ear is there's going to be opportunities to take over broken deals, half-built deals, deals where, maybe the developer got underwater and needs to bail out. There's going to be more and more of those, I think, in the coming year or two. And then other than that, it's, like Andrew and Jimmy, you both said, you really just got to focus on what your strengths are, and what's going on in that market.
Good stuff. We got another comment in here from Andy Hagens. Andy wants to know, how common are lawsuits in the real estate syndication world? For example, if a deal goes bad because the operator executes poorly, how many LPs just understand, hey, there was risk involved here, I'm going to write this off, I'm just going to walk away, versus actually pursuing legal action?
Not many, fortunately. I can't say that I've been involved in any yet. I know of several involving, some sponsors that were pretty cavalier, at the beginning of the OZ, 2018 cycle, where maybe they got ahead of their skis and did too many deals, and it's like investors don't know where their money is, and it's really concerning, because that does happen. But so far in the last 5 to 10 years, there haven't been too many lawsuits that I'm aware of. I see a lot more lawsuits in the construction industry between developers and the subs. That's ticked up quite a bit in recent years.
Yeah, I'll bet. It seems like lawsuits oftentimes are reserved for cases of malfeasance or fraud, rather than just the deal not working out. But Andrew, and any other insights from you on this question from Andy?
Yeah. So my practice is very narrowly focused on securities, and maybe because of that, I'm like built into the algorithm. So like, I've got a ton of visibility on securities related lawsuits, and they're not always because a project fails. They could be for something as stupid as because an investor requested information from a project sponsor and the project sponsor refused to deliver it. So I wouldn't want Andy or anyone else to dismiss the possibility of a lawsuit from an unhappy LP. You want your LPs to be happy, and you don't want them to be litigious. But what's great about this world of real estate syndication is that we're partners in a partnership. So let's be productive partners and talk about how we can work together to optimize the value of the asset that we're coming together to invest into. And we can do that if we're thinking thoughtfully about how to organize our real estate syndication, so that, again, going back to our previous discussion point, there's no gap between expectations of your LPs and expectations of your GP. Everyone understands and is going into the partnership with eyes wide open about what their respective obligations, rights, and responsibilities are.
All right, interesting. Well, let's move on to this next comment here. I've got a question from Fernal Hogan, and he's bringing up opportunity zones. I think he knows us from our time in the opportunity zones world. So this gentleman asks, do real estate syndications seem to thrive more in OZ designated areas? And I've got a couple of thoughts there, but we'll start off with Andrew. Let's head back to you to kick us off on this one.
Yeah. I would answer this question probably the other way around. I would say OZ syndications thrive more in real estate assets by far. The majority of investment partnerships and opportunity zones are investing into real estate across asset classes, even though they're not, you're not limited to investing into real estate in opportunity zones. The industry is dominated by real estate syndications.
And Brett, what do you say? Do real estate syndications seem to thrive more in opportunity zone designated areas?
Well, in certain designated areas, they certainly do. There's still a lot of OZs out there that don't see a dime, right? But I think what the opportunity zones have done is they've brought a lot more people out to the real estate syndication industry. More people are in this market, and what's really cool about that is they can do both, right? And there's no reason why you can't do both. And maybe you start with an OZ deal the first time, but then you realize, well, yeah, I can hire Brett or Andrew to do a market rate deal that's not in an OZ, and it looks very similar, right? So I don't know that they thrive in the sense that are you going to be more likely successful or not. I mean, that goes to lots of conversations you've had, Jimmy, about you don't want the OZ tail wagging the dog. It's got to be a fundamentally sound good deal, and if it is, that's great. It's in an opportunity zone. You're going to get that exclusion benefit and the depreciation exclusion and everything else that comes into that OZ cycle.
Yeah, good thought there. And then just a few thoughts from me. I would say if you are a sponsor or a syndicator and you're raising capital for a deal, you might want to ask yourself, well, who is my investor base, or who do I want to go after, or how do I want to market this deal? And I would say if you have an investor base, some existing relationships with investors who have capital gains, or if you want to use the capital gains tax incentive as a marketing hook or capital raising tool for completing the equity part of your capital stack, I would say an OZ deal absolutely may make sense for you to look at. But I don't know if they necessarily thrive any better than a market rate deal, the way you put it, Brett. I will say if we look at areas that were designated opportunity zones and we look at areas, other low-income areas that weren't designated opportunity zones, there's far more being built in opportunity zones than other low-income tracts. So that's one thing to think about. EIG just came out with a great study, hundreds of thousands of new addresses, new residential units in opportunity zones compared to non-opportunity zone low-income areas. But anyways, I don't want this to turn into a big OZ ramble like it does on my other show, the Opportunity Zones podcast. So let's move on. Great question, though, Fernal. Really appreciate it. Let's move on. We got time for one or two more questions here. Another follow-up question here from K-Ho. He says, great answers. By the way, how do we look for underwater deals? I know one of you brought that up a little bit earlier in the show. So how do you find distressed deals or underwater deals, and what are the typical sizes of those deals? I forget which one of you brought that up before.
Yeah, I mean, the size runs the gamut, right? I mean, it could be $1 million up to $100 million, or less or more. And I think the best way to find them is just to talk to people in the industry. Talk to brokers. Watch the news. See what's happening. In the court system. Maybe in the bankruptcy and foreclosure listings.
Yeah. It's not a real estate syndication question. It's just a real estate question, right? Buy low. You want to buy low and sell high. So knock on doors, call people, network. Try to find those deals that are off market or in receivership, so that you can buy low.
Great insights today. We're out of time. Thank you, everyone. I appreciate all of you who are attending live. And thanks also to my two expert panelists today, Andrew and Brett. Thank you both for joining me today. If you're interested in following up with today's guests, you can learn more about Andrew Doup. He's located in Phoenix today, but he's typically located and headquartered in Columbus, Ohio. You can visit his website.
That's right, actually.
Go ahead.
Jimmy, I'm in Phoenix to celebrate what goes right with the real estate syndication. I'm here for a client ribbon cutting for their project. And I have to thank Brett. Brett and I connected in person here in Phoenix, and he was kind enough to offer me some office space here at his firm. So thank you, Brett, for hosting me.
I love this. This is the first I've got two guests on the show, but they're located in the same building, but on different computers. That's awesome. Well, if you're interested in following up with either of today's guests, you can learn more about Andrew Doup by visiting his website, syndicationcounsel.com, and Brett Siglin is available at fenimorelaw.com. Our next episode and live stream will be on YouTube next Thursday at 3 p.m. Eastern Time. You're invited to attend that live stream and ask your questions about starting a fund or real estate syndication so that I can answer your questions in real time. And please be sure to subscribe to us on YouTube. And if you enjoyed today's episode, hit that thumbs up button. It goes a long way for us. We would really appreciate it. By the way, Fund Playbook is now also available on Apple Podcasts and Spotify. Just search for Fund Playbook on the app or visit fundplaybook.com and click the Apple or Spotify button. Thanks for watching and listening, and I'll be back next week with another episode.